This book is the best $21 I ever invested, and in this video I'm going to share with you exactly why that is. So here are 7 lessons I learned from this book on how to invest your money to build wealth. So we're going to start off with lesson number 1, the biggest investment mistake you can make. So if we continue down this train of thought, Collins explains why trying to time the market is the biggest investment mistake you can make. So let's imagine that these 2 oranges are 2 shares I own in a company and they're right now worth $8. One day the price drops to $4. So I get a little scared and thinking that it will definitely drop even more, best to save whatever money I do have and sell it right now. So I sell it, leaving me with $4 in my bank account and no oranges. Right now I could buy them back at the same price and I will have lost no money. But let's say that what happens instead is that they start increasing in price. All of a sudden they are back at the original $8 price. Now I get scared that they will increase in price even more, so I better buy it back before it's too late. The only problem is that now I can only afford 1 orange. Remember, it's the exact same oranges that I used to own. So now not only have I lost $4 in this attempt to time the market, I've actually lost even more than that, because I've also lost half of my oranges. And this is a double loss that you risk whenever you sell your shares at a loss. Because now I have to dig into my bank account and get a crisp new set of $4 just to get back to where I started. So now if we can understand that at a core level, then what if every time there's a price drop, we flipped it around and started viewing price drops as sales? So when there's a sale on a certain t-shirt, you would go in and buy 2 probably because there's a sale, so you might as well get 2 for the price of 1. You could also view price drops in the stock market this way, where there's a sale on stocks right now, so you might as well go buy 2 shares for the price of 1. Better stock up, pun intended. Collins also points out the classic $1 million bet that Warren Buffett did against hedge fund managers, where he basically bet them, or the bet was essentially, I will pay you $1 million if you can beat the index over a 10-year period. And essentially these hedge fund managers are trying every single day to time the markets, and no one was able to beat the index in those 10 years. Meaning that if the best people in the world, at the largest hedge funds in the world, are not able to time the markets, then I definitely can't. And this is also a really strong argument for why you should never, ever, ever, ever fall for your bank's advice to manage your investments for you at a really low fee, because they will charge you money for a service they cannot provide. Number 2, the investor mindset. And the author J.L. Collins explains that the biggest mindset mistake that happens in investing is when people think owning shares means having money in a company. If your shares prices go down, it might feel like you're losing money, but in reality you still own the same shares. It's pretty much like owning a house. If its value drops, you still own the same house, and it is still the same house no matter the price of it. So the house in this case still represents real world value in terms of protection from the elements, a kitchen to make your food, and a place to sleep, etc. This value will always exist. So by that line of thinking, if the price of your house has dropped, have you actually lost any money? And by the same token, if your house increases in value, have you actually earned any money? Because if you get paid what your house is worth when you sell it, then no matter how much more money that is than what you paid for it originally, you won't be able to buy a better house. You will only be able to buy an equal house to the one that you sold. And so the key here is that money is a representation of value. Money isn't value. Now the difference between owning a house and owning shares is that a house doesn't typically grow or shrink over time. It usually stays the same over time, which means that if its value increases or decreases, it's not because the value of the house has actually increased or decreased. The house stays the same. But with companies like Apple, it can actually grow or shrink over time, which is where the real world value increases which is then represented by the money or the prices of those shares. You can think of this like planting a tree. You buy this tiny little seed and you put it in the earth, and then over time it grows and gets bigger and bigger, and all of a sudden it starts producing fruit. And at the end of like 10 years, it's now a fully grown tree that produces tons of fruit every single year. That tree is worth way more than the seed that you originally bought. And that's exactly how investing in the stock market works. Number 3, building a strong portfolio, the simple approach to investing. Hopefully you now know what not to do, so now it's time for the what to do. And Colin's most adamant point in the book is to keep it simple. So what he advocates is a sort of set it and forget it type of approach, which might seem a little bit scary, but if we think back to the fact that timing the markets is impossible, even for the best people in the world, they cannot do it consistently. And so a set it and forget it type of approach actually makes a lot of sense. But now the question is, where should you actually set it and then forget it, according to Collins? So you might have guessed it, but Collins' advice is to focus your energy on low-cost index funds, and specifically those that track the overall stock market. And this is basically to protect yourself against the very real possibility of you just investing all of your money into one single company, and then that company going straight downhill after you invest in it, and then you losing all of your money. So what he advises, or what he recommends, is something like the S&P 500. And the S&P 500 basically represents the 500 largest companies in the US, all in just one fund. And the idea here is that instead of you running the real risk of losing all of your money if you invest in one company, now you've spread it out to 500 companies, which means that even if one of those companies goes completely bankrupt, you only lose 1/500th of all of your money, which kind of protects you against catastrophic loss. And that's basically it. That's his whole investment strategy, which might seem deceivingly simple, but one of my favorite quotes of all time is a quote from Jim Rohn, which is, "Things that are easy to do are also easy not to." And that quote just applies so well to the situation, because this approach might seem overly simplistic and too easy, and if it was that easy, then everyone would be rich and it wouldn't be a strategy that you could use. But this is what I like to call the simplicity fallacy of life. And that's our tendency to think that the more complex something is, the more likely it is to work for whatever reason. But the reality is that the results don't come from the complexity of the investment strategy. The results come from the discipline to invest money consistently over time. And that is the hard part. Same as with anything in life, it's not the most complex workout routine that will get you the best results. It's actually just going to the gym consistently for years. That's what's going to get you the results. Things that are easy to do are also easy not to. And to add to this, I wouldn't feel comfortable recommending any of this stuff unless it was for the fact that I have been using this strategy for the past 2 years, and so far it's been working exactly as advertised. Number 4, the psychology of investing. The really beautiful thing about the set it and forget it approach is that it saves you from the beta investor disease, a term I just made up, which is basically the constant anxiety about your investment, constantly looking and trying to figure out, what is the market doing? Is it up? Is it down? Is it sideways? Is there a crash coming? There's definitely a crash coming. I should sell. And so Collins' set it and forget it approach has some really strong psychological backing behind it, which is that if we look at index over time, so the stock market over time, it tends to grow at about 5 to 10% every single year, at least if we look at historical data. And that means that if you were to only look at your entire portfolio once every single year, then on average you'd be pretty happy seeing about 5 to 10% growth year over year for a really long time. Whereas if you look every single day, then one day the stock market might be up by 5%, the next it might be down by 10%, and then up and then down. And throughout the entire year, there's going to be so many ups and downs. And this is one of the reasons why a lot of people make the biggest investment mistake you can make, which again, so you remember, is trying to time the market. Because you see a drop and you get scared and you want to sell, and seeing your investments drop by like 10% is scary. But if you plan to invest for 10, 20, 30, maybe even 60 years, then does it really matter if there's a crash today? Does it matter if there's a crash in 2 years? Not really, because if the past is any indication of the future, then there will be a lot of crashes during the next 20, 30, or 60 years. But on average, it's going to recover and it's going to bounce back way higher than it was before the crash. And even if you feel like this crash is going to be worse than any crash in history and the stock market will never recover from this, if you truly believe that, then I have a newsflash for you. And this newsflash is that is basically an apocalypse. That's going to be a very dystopian future where your money is it's basically going to lose its value, most likely. And you won't need to care at all. This is going to be the least of your worries that you lost money in the stock market crash, because your money will probably be completely useless no matter how much of it you have. Number 5, emergency fund. So speaking of apocalypse, Collins emphasizes the importance of having an emergency fund to basically help you with unforeseen future expenses. So we recommend saving up 3 to 6 months worth of living expenses, and this is to be used as a financial safety net. And this money you want to keep in just a regular savings account, because this is money that you will most likely be using every now and then. And so inflation is not going to be a factor. And the idea behind this is to give you a buffer, basically, a buffer that is intended to be used. So let's say that your car's engine breaks down, for instance, and now you have to pay to get it fixed. The emergency fund exists exactly for this purpose, so it will feel like less of a loss to use the money from that fund to pay for this service. And most likely it will even feel a little bit empowering to know the fact that you had the money saved up and you were prepared for this event and you were now able to pay for it. Number 6, understanding the power of compounding. So I tried to come up with the best way to visually represent compounding and to get this concept to go across. And this is what I came up with. So let's say that we have oranges. We invest with oranges. The first year I put 1 whole orange in my account. And let's say that every year, like clockwork, my investments double in value. That means that after 1 year, I will have my original orange plus a whole nother orange, double the amount that I started with. Now let's say that another year passes. How many oranges will I have at the end of that year? Still assuming that the value doubles every single year. So what we now have is a total of 4 oranges this year, because every single year the total amount that I have doubles, not the original amount. So that means that now I have 4 oranges, and if it doubles every single year, the next year we have 8 oranges. And again, 1 year later after that, we have 16 oranges, and so on. So even though the growth rate stays rock steady at 100% every year, the amount of oranges we get every single year increases exponentially. Now this was a pretty crazy number because you'd never really expect 100% growth year over year consistently, but it was just to kind of illustrate the point visually. And I think this power is just as palpable at a smaller scale. So let's imagine that you don't invest, but you put your money into a regular savings account. So you put $100 each month, let's say. And let's say that you do that for 10 years. By the end of those 10 years, you will have saved up a total of $12,000. Now, if you instead invested those $100 each month into an index fund that on average had a return of 5% per year, let's say, you would instead have $15,093. Now, here's the truly mind-blowing part. By expanding the time horizon for how long you invest, this escalates like crazy. If we instead pretend that we did this for 30 years, we would have $79,726.62 compared to $36,000 if you only put it into a savings account. And that is the power of compounding. It turned out to be more than double the amount of money with the exact same input every single month of $100. Number 7, when to sell and how much. Now this is one of the most important parts of this entire video, and this is one of the most important part of investing in general that I never really heard anyone speak about before I read this book. And that's basically the question of, well, if compounding is really important, and compounding only works if you leave your money in the market for a really long time, and selling is not good because then you'll most likely lose money, then how do I use the money that I invest? And the answer to this is brilliantly simple, according to Collins, and that is 4%. And what this number basically represents is that you can usually sell around 4% of your investments every single year, and you will still maintain your investments. So your portfolio should be growing at a rate that outpaces a 4% withdrawal rate every single year. It won't grow that much if you keep withdrawing 4% every single year, but it will maintain and it won't decrease in value over time. That is the concept behind it. And so this is how you then calculate how much money you need to have invested in order to live off of your investments. You basically take whatever living expenses you have for an entire year, you calculate that number out. Let's say that it's $20,000. That $20,000 that you need for an entire year represents 4% of what you need to have invested in order to live off of your investments. So let's say that we have the $20,000. If we want to figure out how much 100% is, or how much total money we have to have invested in order to get 20,000 every single year, then what we do is we divide 20,000 by 4%, and what we get is 500,000. And so what we need to have invested is $500,000, and that will then allow us to withdraw $20,000 every single year without decreasing the value of our portfolio. And this is literally one of the biggest takeaways for me from the entire book, because it's such a clear and specific way to approach financial independence and to set a goal for achieving financial independence. Now, I really hope that this video was useful for you, and I highly recommend getting the book even though you've watched this video, because it will just solidify the information a lot more. I had the audiobook and I've listened to it several times just to make sure that this information sticks, and just making this video as well is just a way for it to stick better in my mind. If you want to buy the book, there's links in the video description, and if you buy it through one of those links, it helps support me and this channel without actually costing you anything extra. And either way, I really appreciate you for watching this video, and I hope I'll see you in the next one.